I'm Elliott Prechter, and I'm the lead developer of EWAVES, which is currently the world's only genuine Elliott Wave analysis software engine. So we're here with the foundation for the study of cycles, so I'm sure everyone in this room is already quite familiar with Elliott Waves. You're probably familiar with many other forms of technical analysis. But nevertheless, there may be a few people in the room that are not that familiar, so I'd like to do a little overview here for you. Plus, everyone likes to feel smart, and nothing makes you feel smarter than when someone teaches you something that you already know. So, on this chart, this is an idealized version of an Elliott wave. And under Elliott wave theory, the market moves in two primary waves that form a cycle. Okay? So the first wave is called a motive wave, and this is the wave that makes progress in the market. And it's followed by a corrective wave, which is a move that is a partial retracement of the motive wave, okay? So motive wave and corrective waves, you've probably seen these all the time. If you're a trader, you can think of the motive wave as the primary trend, and then the corrective wave as a retracement of that trend, okay? So everyone is familiar with these kind of basic concepts. Now, motive waves tend to be highly linear moves. So again, these are the moves that make progress. So there's not a lot of overlapping price action. They tend to be very line-like in their evolution, whereas corrective waves are the opposite of that. So corrective waves tend to be a little more meandering in their evolution. They tend to have a lot of overlapping price action, and again, they're just a partial retracement of the motive wave. Now, of course, Elliott waves are all about patterns. So the way that the pattern works is motive waves and corrective waves decompose into subwaves. Okay, so if you look at the chart here, the way we label motive waves to distinguish them from corrective waves is we use numbers. So you can see the numbers here, 1, 2, 3, 4, and 5. And then for corrective waves, we use letters. So we have A, B, and C. Okay, now this pattern follows certain rules. So there are certain things that the pattern absolutely cannot do. And it also follows guidelines, and these are probabilistic behavior. So if you've read Frost and Prechter's work from 1978, the Elliott Wave Principle, you'll know some of the cardinal rules. So if you're labeling a real-world chart of a financial market, you know that wave 2 here cannot break below the origin of wave 1, which is right here. You know that wave 4 cannot overlap the end of wave 1, or the extreme point in wave 1. And you also know that the third wave here, this move, cannot be the shortest wave or the smallest wave in a sequence. So these are constraints that we have on our model. Now, like I said, there are also guidelines. So one of the guidelines that I like is that wave 3 tends to be the largest wave, okay? But it's not always the largest wave. Sometimes 5 can be the largest wave. Sometimes 1 is the largest wave. That's probably the most rare formation, but that does happen. But generally speaking, most of the time, wave 3 is going to be the largest wave. Now, the last thing is that you'll notice there's a lot of complexity on this chart, but that complexity just comes from the fact that every single subwave here on this chart itself decomposes into its own Elliott wave pattern, forming a fractal. So you'll see that this entire picture here of a motive wave followed by a corrective wave, you'll see that same picture forms right here within the very first 1, 2 on this chart. So there's our 5 waves up and 3 waves down. So if you're new to this, I apologize. It's kind of like riding a bike. It's actually very simple once you get used to it, but if you haven't done it before, it can be a little difficult. But if you just remember, when you have 5 waves up, you're about to have 3 waves down, that's enough. And you'll be able to follow along with some of the charts that I'm going to show you. So this is my favorite Elliott wave of all time. Those of you who've been around for a while might immediately recognize this period as the GFC, the global financial crisis. And this has a special place in my heart for a couple of reasons. Number one, I think it's just a really beautiful Elliott wave pattern, very, very clean. But also, this event is what got me interested in finance. So my entire life, I was very interested in technology. And believe it or not, I had no interest in finance or knowledge of it really whatsoever until much later in life. So here on the chart where it says top, that's in September 2007. Back then, I was about 1 year into my very first job at Microsoft and doing nothing even remotely related to the markets. But a year into my first job and being one of the cheapest people that I know, I'd saved up some money, and I thought, I have no idea what to do with this, with my savings. It was just sitting in a savings account at Bank of America. So, believe it or not, I connected with a financial advisor at the time, and they said, the best investment that I found are these unrated municipal bonds that are backed by real estate. And don't worry, it's a sure thing, and the fact that they're unrated gives them extra high yields and it's tax-free. And I think they were paying 13% tax-free, and I just thought, I did the math and I was like, oh my gosh, this is the best thing ever. So I called up my dad, who many of you know, who's Robert Prechter, the founder of Elliott Wave International. You can probably already guess what he said when I told him about the municipal bonds. So, he told me, we have a big real estate bubble, and not only to stay away from these bonds, stay away from stocks, and you might not even want to be in the banking system, because I think a lot of banks are going to fail. So I said, oh goodness, well, okay, well, what do I do? So I read his book, Conquer the Crash, probably 20 times. It got really dog-eared. And so I took my money out of Bank of America and put it in a Treasury bill money market mutual fund. But of course I was 23, right? And I'm sitting here thinking, well, this is kind of boring, sitting in these Treasury bills, getting a small yield. I think something exciting is about to happen. I want to participate. So what I did is I took my money out of the Treasury bills and I put them into the Prudent Bear Fund, which is run by a man named David Tice. Some of you might know him. There weren't actually, at that time, there weren't very many bear market funds, although today there's probably even fewer. They're pretty much going extinct. So I put my money in the fund, which at the time I didn't even really think about it. I think today I would have been scared to do it, because if you looked at the fund at that time, it was just going straight down like a falling knife. But I was just, I was 23, so I was excited. So I just put all of it in there. And sure enough, the market started to take a tumble. And I was noticing the bear market fund was going up. And I was like, oh, this is exciting. But then I noticed that as it was going up, it was doing so in waves. Okay? So it went up in a 5-wave sequence. And I was, of course, reading the Elliott Wave Theorist and the Elliott Wave Financial Forecast, following along with them. And they showed that the market had indeed done 5 waves down, 1, 2, 3, 4, and 5, down to this wave 1 here. And this is where the fractal comes into play, because you've got a small wave 5, then you're going to have your ABC, and this is all part of a larger 5-wave sequence down to the bottom there. So again, being young and foolish, I decided to take another big risk, and I thought, well, shoot, why am I sitting in this bear market mutual fund when I know the market's about to go in the exact opposite direction? So I sold all my shares, and I bought a 2-to-1 long fund ETF using 2-to-1 margin. So I was 4x exposed to the market. But yes, the market did skyrocket up at this time, so that was great. And I was a member of this investment club at Microsoft, and I was probably spending more time than I should talking to this list, but I was telling people on the list, I'm buying the market, with all this leverage and everything. And I got a lot of responses from people saying, wait a moment, you've been talking on this list for a while about this bubble and this collapse, and you're going long, 4-to-1, what are you talking about? And that's when I had to explain to them that, the market is a fractal. It doesn't move in a straight line. And in fact, even the idea of the market having a direction is a little strange, because the market is always moving in different directions, just depending on which time frame you're talking about. So of course, in retrospect, if I were to go back in time, I would have just bought a bunch of deep out of the money puts and just held on the whole time instead of trading. But I think it was good for educational purposes to actually actively trade this market. So in any event, I continued trading my way through this pattern. And I was lucky in the sense that it was a very clear Elliott Wave pattern. So Elliott Wave International was, of course, one of the few firms to call the GFC in advance. But more so, I think what made them unique was the fact that they called almost every little squiggle on this chart. So that's why I had such a good time trading my way through this. Then, of course, the bottom came over here, the far right of the chart. And I want to say they called that within plus or minus a week of that final low, saying that we'd have the largest rally that we've had since the GFC began. And of course, you know that should be coming because we've got 1, 2, 3, 4, 5, right? The pattern is complete, so we need to have a large move in the other direction. So needless to say, at this point, I was just completely hooked, become an Elliott Wave addict overnight, thinking, gosh, I can just quit my job and trade all day long now. I'm a genius, which is definitely not true. I was going to learn that lesson a little later, but we'll skip over the lesson part of this for now. I'm just going to leave it with you with this moment of triumph. But one thing I've noticed, which I'll kind of circle back to in the talk, is that I've found that periods of time in the markets that are highly emotional tend to have very clear technical patterns. And so I find it almost ironic that a period of time that for me had so much clarity to it, for most of my friends seemed very unclear, and they were very upset about what happened during this time. But I think the market going down versus the market going up are kind of equally natural. So if you're a trader, especially if you're a short-term trader, the market is moving in both directions all the time, and you need to think in a neutral fashion. All right, so we're going to skip ahead many, over a decade. A lot of stuff happened in between the GFC and where we are today. But I just don't have time in this talk to go through the entire evolution of what happened. So we're just going to skip forward here to today. Okay, so the EWAVES engine that I developed does the Elliott Wave analysis. And then what you're looking at here is EWAVES Live, which is a web portal that we've built that allows you to access that analysis. Because it's 2025 and nobody wants to install, shrink wrap software anymore. I've noticed also the FSC, you're doing your software through a web portal as well. This is the way everyone delivers it these days. So we're covering probably around 6,000 markets now that we're doing automated Elliott Wave analysis on. Now, we have plans to scale up beyond that, but we're kind of scaling with demand because people basically request, can you add this market? Can you add these markets? So we're slowly kind of growing as the demand comes in for those. Now, although what I'm showing you here in this chart is just kind of a snapshot of an Elliott Wave pattern, I think this is back from 2023 in Apple Computer. Unlike most analyses you see that are published or hand done, these are actually zoomable charts. So the Elliott Wave analysis is in fact contiguous over the entire data set. Okay, so every analysis that eWaves does starts at the beginning of the data set all the way through to the present day. So for some markets we can't get very much data on, so we have to just work with what we have. But there's some other markets like the S&P where we go back quite far because we can prepend data from the London Stock Exchange and kind of pretend that that was old data and go all the way back to 1697, which for Elliott Wave analysis is very useful because not only do we care about the very short-term price action, we care about the very, very long-term context. So if you saw, Peter Elliott's talk the other day, he mentioned about trend lines going all the way back from 1929 to 1966 through onto the present day, and those trend lines are still important no matter what time frame you're dealing with. So one thing that's happened when we built eWaves is because traditionally Elliott Wave analysis takes a lot of time to sit down and work with a chart and come up with a good wave count. But now that process is quite fast. So now the problem becomes, how do we sift through all these markets? If you have 6,000 markets, that's a lot of Elliott Wave analysis to go through. So one of the first techniques we came up with to make it easy to go through and find compelling charts is a concept that we call Ellioticity. So Ellioticity is the degree to which a market is adherent to Elliott waves. And if you remember earlier, I said, when markets are highly emotional, they tend to display very clear patterns. And when they're less emotional, sometimes the pattern is not so clear. So that's why we use ellioticity, which is a real-time metric. So, at some points in time, if you wouldn't mind just remember that, and then at the end, we'll come back and I'll be happy to answer all your questions. So, what was I saying? Okay, so it's a real-time metric because sometimes particular markets will become highly adherent at certain points, less adherent at other points. And then there are other markets that just never display Elliott waves, like short-term treasury bill rates. If you've ever looked at those, I'm sure you can use cycles on them, but you certainly can't use Elliott waves for those markets. Now, this can be hard to read because the text is very small. We probably need to make this bigger, but the ellioticity on this particular chart of Apple is only 49%, which is pretty low. So I'm just curious if there are any Elliott wave experts in the audience who might know why this got kind of a low score, if you would like to volunteer. If not, I'll tell you because I know the answer. What?
Is it because of the time horizon is too short?
Time horizon is too short. That's actually not the reason I'm going for, but that's a good guess because they're.
Is it the retracement is too short?
For wave 4 or wave 2? Actually, in this case, what I'm going for is the total size of wave 4, the retracement in 4, is actually too large relative to 2. So what we like to see is that 4 and 2 are in proportion to one another, okay? And so what eWaves does is it's saying, look, this is the best way I have to label this market, but I'm communicating to you that the best way I can label this might not be, I don't have a lot of confidence in what I'm delivering to you, okay? And so I'll show you other markets later on that have very high ellioticity and look much nicer than this, okay?
How many rules do you have to get the 49%?
Rules?
Rules to comply with the Elliott wave.
Rules or conditions.
Okay. Well, the ellioticity itself actually has more to do with guidelines than rules because those deal in probability, okay? The rules are always there. Like I won't show anything I show you on a chart must follow the rules, okay? But there's about 200 or 250, just so you know.
I'm just going to ask one question now. Elliott, similar to like a Bartel score in statistics, kind of the efficacy of that, correct? Like the higher ellioticity, closer to 100, the better it is.
Yeah, basically, you can think of it as kind of a measure of commonality, I guess, or frequency. Like what it's telling you is that, okay, if this has a low ellioticity score, then what it's saying is this is not a common expression of an Elliott wave. Whereas if it's a high score, it's saying this is a more common form that I like to see. Yes. Here's the obligatory after picture where the market did indeed move higher. But the point I wanted to make here was that, if you remember from the beginning of the talk, sideways moves, the corrective moves tend to be kind of meandering, tend to have a lot of overlapping price action, which this move down does. So even though I said 2 and 4 were out of proportion, from a pure trading point of view, as long as that indeed was a correction, then you can still trade successfully with it, even though you might not have the best ellioticity. But that said, I would recommend looking for much higher ellioticity markets. So personally, I would completely avoid Apple. All right, so let's move on to a market that everyone cares about and everyone's been watching, the S&P 500. And this is a much more recent chart. This is from February 24th, 2025. So this is just a few months ago. But if you'll notice here, on green, these are the highest degree labels on this chart. We have 1, 2, 3, 4, and 5. And again, it's a fractal, so you can see within wave 3 itself, we also have 1, 2, 3, 4, and 5, okay? Now, what happens after 5 waves up? Okay, we're going to get a move in the opposite direction, okay? And, if I put my trader's hat on here for a second, I think, okay, if I want to short this market, obviously one advantage of Elliott wave analysis is that you can often put a very tight stop to control your risk in case your count is incorrect. But I also might want to know where to cover, okay? So what's kind of a conservative target here? Now, in the 1978 book, The Elliott Wave Principle, they actually mentioned this. They said a conservative target, once you have 5 waves up, is wave 4 of 3. Okay, so this is wave 3, and this is 4 of 3, right around 4,900 on the S&P. So that would be, just using that knowledge from the book, that's a good place to cover. And if we just fast forward here, you'll note that the market went right around that level, actually slightly exceeded it, and then we had a really, really sharp bounce since that time. Now, what I like about this is that these concepts from a book written in the 1970s are just as applicable today to the markets as they were back then, okay? And in fact, they're just as applicable as they are to Elliott waves from the 1800s or any other time frame, which is something we've actually proven, and I'll get to that later in the talk when we start talking about statistics. But let's save that for later. But this is a really important property of Elliott waves because it distinguishes it, I think, from a lot of quantitative systems that are not like that. Okay, I want to talk for a moment about pet markets and pet market syndrome. So you probably have pet market syndrome. I know I've had it many times, or you at least know somebody who has it. So what pet market syndrome is just show me the S&P. That's what I care about. I don't want to look at anything else. Gold is another popular pet market. I've noticed that people just really get obsessed with gold. I've had a lot of people write in saying, all I trade is Bitcoin. That's what I want to see. I don't care about anything else. But for me, I've noticed that, okay, well, yes, sometimes we do have nice wave counts on the S&P, but there are plenty of other times where you really don't, where the best answer is, I don't know what the S&P is doing right now, so who cares? Why don't you go and look at other markets that might be clear and ignore the ones that are not clear? So that's why we're running E-Waves on 6,000 markets and counting, because we want you to be able to find markets that are clear, okay? So towards that end, in addition to things like the Ellioticity, which we use for ranking, what we built is something we call the Wave Finder. So if you use an Apple computer, you may recognize we stole the word from Apple for the Finder system. The Wavefinder is the world's first Elliott Wave search engine, essentially. So what this does is it's not so much that it scans through markets, but it scans through the unfolding waves in the various markets, okay? The way this works is you build a query, a wave query, okay? And here you specify the parameters of what I want to see. What kind of picture do I want to find across all these markets? And the E-Waves is going to give you all of the unfolding waves that meet that criteria, okay? And there are built-in templates that we've put together, and you can also customize and save your own. But the template here I'm going to show you is the one that is my personal favorite that I've been using lately, and I used it to find this example in BRO that I'm going to show you here. So what I said was, and I apologize that the text is a little bit small, but as I read it, you'll be able to understand. So I want to find a wave. That's a currently unfolding wave. And what type do I want the wave to be? Well, I want an impulse. Because remember, impulses are the waves that make progress. Okay, so if you're a directional trader, you're going to want impulses. I think I had one person ask me, tell me that they really were more interested in triangles and sideways moves because they wanted to sell time premium with options. But I think that's rare. I think most people want impulse waves. Okay? Then the next thing I set here was the duration. This is how far the wave has been in progress thus far. And I said between 100 and 800 days. This part is a little bit subjective because it just depends on what your preferred time horizon is. Do you want to look at large waves or do you want to look at smaller waves? And this captures the waves that I'm personally interested in. Then the next thing on the list here is the linearity. Okay, so remember from the beginning of the talk, I said motive waves are highly linear. They're very line-like, whereas corrective waves are more kind of two-dimensional in the way they play out. So linearity is how the engine measures that. So in this case, I set it to 80%, so I jacked it up to a really high number. And the reason I did that is because what I'm saying is I don't just want any old impulse wave. I want an impulse wave that is especially impulsive. And I think marketing came up with the term turbo impulse for this template. But basically, I've noticed that these types of waves tend to work out better than ones with much lower linearity. And then finally on the list, I just put in a bare minimum Ellioticity score. I said, look, if it's below 30%, I don't even want to look at it, because then it's going to be just a poor quality Elliott wave. Of course, upon delivering the list of waves that met this query, the one at the top of the list, I'm showing you here, BRO, this one got an Ellioticity score of 75%. So it's saying this is extremely adherent. So this was the top ranked market at this time. So why is the Ellioticity score so high? Why is it 75%? Okay. We talked earlier about proportionality between waves 4 and 2, and I think you can see here it's met that. It's meeting a lot of other criteria, and we call these criteria features, okay? And you're asking about the number of rules and guidelines. We kind of merge the concept of rules and guidelines into just one concept called a feature, and there are about 250 of them right now. And one of them that I'll show you now, we call channel adherence. Okay, so even if you haven't done Elliott waves, I'm sure you've used price channels before in your trading. They can be very, very useful. So what EWAVES does is it says, let's draw a line, in this case from the 2 to the 4, all right, the green 2 here to the green 4. And then we're going to draw another line on top of that from the green 1 to the green 3. And then we're going to measure how parallel are these lines, okay? Because if they're very parallel, then this market is very channel adherent, versus if they're not parallel, then it would not be channel adherent. And this is one feature that we like to see with good quality Elliott waves. So this one particular aspect of this is really telling us, hey, this is a really nice way of labeling this market. I like this. Okay, so it's boosting that Ellioticity up. Now, not all markets channel very well. Some markets channel very poorly. But nevertheless, that's why there's 250 different things that it looks at, because there are other ways to get good Ellioticity, not necessarily through channeling, although I personally really like channeling. And I've also noticed, for some reason that I can't explain, that markets that are highly linear also tend to have very high channel adherence. I don't know why that is, just the real powerhouse impulse waves tend to also channel well. Now, one final thing I'd like to mention on this chart is that I'm a big fan of fifth waves. Now, the template I showed you does not specifically look for fifth waves, although it's easy to change the template to say I want impulse waves where wave 4 is in place and complete and finished. And the reason I like fifth waves here is, fifth waves are kind of like getting to first base. Okay, they're not necessarily going to be massive moves like third waves are. This is your third wave. This third wave is like your home run move, right? But think of it, by the time you're at this point in the evolution of a wave, you're actually almost done with the entire picture, right? So because you're almost done, you have a lot of information. Like the channel I'm showing you here, you can look at this picture and say, oh gosh, it's adhering very nicely to this channel. So your odds go up in playing those fifth waves that you're going to be correct. Whereas third waves are much riskier because you have much less information. You have a less complete picture at that point in time. So again, here's the obligatory after picture of BRO. It went off into that fifth wave there. But one thing that I didn't tell you when I showed you these charts was that the date here at the bottom, this is the 24th of February, 2025, the exact same date that the S&P was making a top. And this is just to demonstrate the fact that, the way EWAVES works is it analyzes every market completely independently, because some markets are moving up while other markets are moving down. And it doesn't matter that they're both stocks and that they may tend to be correlated at times, but correlations can be spurious, they can come and go. So we're going to do one more S&P wave count here. So I'm going to take this picture, very recent picture, and we're going to run EWAVES on it and show you the latest labeling that we have. Okay, so this is April 23rd, 2025. So this is just, 7 weeks ago, right here. And you can see it put in a wave 4. And the reason that it put a wave 4 in there is because this is the all-time high so far. We have 3 waves down, A, B, and C. Now, the reason I'm showing it to you on April 23rd, when the market has already actually moved up somewhat higher and not at the exact low, is because although prior to this point in time, EWAVES had put in the low, me personally, I am not willing to come out and show a chart at that moment in time. And I'm going to tell you why, and why at this point in time I was like, okay, now I feel bullish. That's because if we think about alternative labelings here, imagine this, instead of A, B, C, 3 waves down, this could have been 5 down, right? So think about it this way. It could have been 1, 2, 3, 4. But wait a moment. We remember from our rules earlier, wave 4 cannot overlap wave 1. So it was really only at this point, once we had moved up and kind of overlapped this price move here, that I suddenly felt, okay, now I feel very confident that that's definitely a 3-wave move. So the market should be moving higher from here. So, this is something that EWAVES does not do on its own. So that's why it's a tool, okay? It's going to do the wave analysis, but you also have to know a little bit about Elliott Waves, I think, to be able to use it effectively and make those decisions. And in fact, to paraphrase Paul Tudor Jones, I think he has a quote where he said something along the lines of, "No man is greater than a machine, and no machine is greater than a man with a machine." And I absolutely believe that. And Richard has said a lot about this earlier as well, that we need the human element with our technology. The technology alone is great, but there are certain things we can do up here that are very, very difficult for a computer to do. So EWAVES is just focused on doing the analysis, and that's it. That's enough. As far as anything, decision-making on top of that, that's left up to the human element. Okay, here's the after picture up to June 5th, so I guess, what was this, a week and a half ago. I think we've moved a little bit higher since then. Sometimes you can get truncated 5th waves, but we'd really like to see a slight new high in the S&P. There are alternative counts here that I could discuss, but you can get with me later if you want to hear about that, because that could go on for a while talking about that. Okay, I'm personally kind of sick of talking about the stock market because that's all that anyone ever wants to talk about. I think actually a market that's been really interesting lately are interest rates, because you're probably sick of the past, decade or so where we had 0.00001% interest for a long time on short-term yields. And then suddenly after COVID, yields shot up, okay? And then things have gotten great for people who are savers. In fact, proportionally, it's been a huge move. Of course, we haven't seen anything like we did in the 1970s, where we had 15% rates or higher. But if you think about it, going from 0.7% to around 5.2 on the 30-year Treasury bond, proportionately, that's a massive, massive historic move. Now, what I'm showing you here in this chart is the last time that we were bullish on Treasury bonds and expecting rates to decline. And the reason I wanted to show you this chart is just because it has a really cool thing from an Elliott Wave point of view. There's no such thing as guarantees in the Elliott Wave world, of course, but there are things that get close to kind of these checkmate kind of situations, and this is one of them, so that's why I wanted to share it with you. So what we have here is we have a motive wave up, this wave A. Then we have a corrective move, okay? It's a 3-wave move, A, B, and C. And notice this triangle here in wave B, okay? This is a type of corrective pattern. So we have A, B, C, D here. This is a contracting triangle. Now let's talk about alternative ways of labeling this. Let's say, okay, let's pretend that maybe this move here was the end of this entire sequence, this entire corrective move, and that we're going to move down to all new lows, all right? Let's just propose that as an alternate scenario and try to see if we can count it, all right? So let's pretend. So we're going, all right, here's 1 down, and then we have a triangle 2, and then we're going to move down and start wave 3, and we're going on. Well, we already have a problem, because second waves cannot be triangles, okay? There's lots of different patterns they can be, but triangles are not one of them. So because of that, I really love this particular scenario where you have a triangle inside of a three-wave move, because then it gives you just a lot of confidence that you are in fact dealing with a corrective move. So this entire move is corrective with very high odds. And so what EWAVES was saying was, okay, at this point, we should move higher, and we should ideally take out this high, okay? That's all it's calling for, though. Just take out the high, and then, you know, anything beyond that is up to chance. So that move there, I drew a little arrow here, hand drawn, just showing wave C moving up and taking out wave A. But keep in mind, A, B, C is a counter trend move, right? So the primary trend is still down in bonds towards higher interest rates. And in fact, in December of 2024, so right before the start of this year, we published this chart. And this is EWAVES' analysis of the US 30-year Treasury bond yield. I found that the super long-term yields tend to count very well from an Elliott Wave point of view, at least lately since 2020. And I think that's because bond markets got emotional again. So we're seeing clear Elliott Wave patterns. Whereas if you were to look at bond markets prior to this, say from 1980 to around 2020, they're much messier from an Elliott Wave point of view and difficult to call. And I think that's just because yields were falling. So everyone in the bond world was just buy and hold bonds. In fact, if I had a time machine, a great investment would be to go back to 1980 and buy the longest term treasury bonds you can find and just hold them. That would have been. He did that. So that in any event, that corrective move I showed you on the previous chart, that's actually this move here. So this is that A, B, and then that's C. So that's the last time we were bullish on treasuries, okay? Because like I said, you can zoom in and out of the picture. So here we're zooming back out. And you know, we were calling for interest rates to continue higher, at least on the long end of the curve. The shorter end of the stuff, like I said, is very difficult to count, so I don't really bother with those markets. This is the EDV, which is a Treasury ETF that holds very long-term treasuries. So this is kind of, you could look at it as the opposite of interest rates. And we publish this at the same time. And the reason that I do this is because I like to have different looks at kind of the same underlying market, because it is actually different data and it fluctuates a little bit differently. And so by running EWAVES on multiple different kind of views of the same underlying market, we can get more confidence with the wave count. So, you know, I often recommend don't just look at one market, look at other related markets. All right, so if you look at the zeros, which these are very long-term treasuries, or you could look at EDV lately, it has indeed made that new low. So at least on the high end of the yield curve, we're seeing even higher interest rates right now. What's interesting too about this chart is it actually reminds me a lot of 2008. Because if you remember back in October of 2008, there were a lot of people, maybe not a lot, but a few contrarians coming out saying, gosh, we had a big crash, there's blood on the streets, now's a really good time to buy and get into stocks. And of course, in the very long run, that was definitely a reasonable time to buy, but it wasn't the low. That was actually a third wave low. And the S&P and the Dow went and made a new low in a wave 4 and a wave 5. And we're doing the exact same thing in bonds. If you were paying attention to the news back at this low in bonds in late 2023, there were a few, I won't name any names, but a few large people in the bond world that came out saying, hey, there's blood in the streets in bonds. You know, we need to start buying bonds now. But that I believe is also a third wave low. So we've had a correction since then, and then are in wave 5 right now. Which of course does tell you that at some point bonds are going to be setting up for potentially an interesting run. And one thing that my much older self has learned is that assets that don't have a lot of slippage are really nice. So for example, if you were to make a play in bonds, you can earn yield. Yes, you're taking a lot of risk, but at least you're not, you know, having time decay with options or, you know, all the horrible things that happen with inverse ETFs. They're terrible. Don't ever touch them. All right. Now we've looked at a lot of charts so far, and I've been talking about, you know, forecasts using EWAVES. This chart is actually not a forecast, and this chart was not done by EWAVES. This chart was done by a person, by a human. And this is what we call an iconic count, okay? So what makes this count iconic? Well, there's a couple factors. One factor is that it's historical, okay? So this happened a long time ago. There's been a lot of price activity since then. And so, I could hang this on the wall. I could come back in 20 years and look at it on the wall and say, oh, okay, nothing's happened that's invalidated this wave count, right? That's one important factor that makes it iconic. And the other factor that makes it iconic is that every Elliott Wave expert that we talk to that has looked at this pretty much agrees, okay, this is the way we should label this market. So what we did when we were building EWAVES is we went through and did this exercise hundreds of times. And this was a very arduous process that took many years to do and build up this big database of iconic Elliott wave counts. And the reason we did this is because if you're going to build a program that does Elliott wave analysis, yes, we know about the rules, okay? Yes, we know about some guidelines because people have been doing this for a while and they have various rules of thumb. But we don't know them precisely, okay? Guidelines like saying third tends to be the largest wave. Well, how often? Exactly how often? What does that look like? Can you plot me a distribution of exactly the size of wave 3 relative to wave 1? And where do you get little pops up in that distribution? Where does that happen? Which actually, you can probably guess where you do get little pops in the distribution, where you suddenly get this jump in frequency. Oh, we're not doing well on time? Oh, shoot. Okay, well, it happens where there's Fibonacci ratios, so that probably shouldn't come as a surprise to you. I was gonna get to the fun part and talk about ducks. We're out of time now?
Take a few minutes.
Couple minutes here. Maybe I'll just have to skip this part. This was the fun part of the talk. I'm just gonna skip the fun part. Okay. All right, so I think I've shown you so far that Elliott waves are useful in practice, but are they useful in theory? I think that's what the academics really care about. And so we decided we really needed to go talk to the academic world and introduce them to Elliott waves. And the way we did that is we hired a PhD mathematician, and he worked on this paper, which we call Real versus Random. And so, there was a time when some people believed that you couldn't tell the difference between real market data and a random walk. But slowly over time, people started to notice there are little patterns in real market data that don't happen in random walk data, okay? You may have heard of some of these. They're called stylized facts, and one of them is called volatility clustering. Really simple. When the market goes crazy, it tends to stay crazy for a little while, and random walks don't do that, okay? So we said, is Ellioticity a stylized fact? So we did this study where we looked at real market data, and we ran EWAVES on it, and we compared that against random data. And as you can see here, the real data is here in blue, and the random data is here in gray on this chart. And so the conclusion was that, yes, we can show that Ellioticity is a stylized fact of financial markets. Now, I'd love for everyone to read this paper. It's probably about 40 pages long, very interesting. It's not yet available, but I hope to make it available soon. But we're at a brief standstill because a couple of journals are interested in publishing, but they all want the source code. They said, of course I'll publish your paper, but you got to crack open your program that you spent 10 years building and show us how it works, which I understand. I mean, I would want that as an academic. I want to replicate what you're doing. I completely understand. There's just no way I'm going to do that, so for obvious reasons. So we're kind of at a standstill right now. I'm not sure what we're going to do moving forward. Hopefully we can find someone who will publish it without the source code. If not, then we're just going to self-publish. So if you're interested, just go to ewaves.com, and there's a news section. You can sign up for email updates, and if the paper does become available, we'll let everybody know, and then you can take a read. So that's all I have for today. So thank you so much for letting me come and speak.